So that's it for another fantastic annual investment forum. Here are the key messages from some of our sessions.
Do you want to find out who's flown on a private jet with Paul Allen, who is one of the founders of Microsoft, to actually do due diligence on startups in the US? Well, this session will cover that, as well as why we think US exceptionalism is going to continue, and why there are more opportunities in the US than there are perhaps in the rest of the world. Tune in for this session with Fabiana Fedeli, CIO of M&G's multi-asset, equities and sustainability team, and she interviews Stefano Amato, Dan White and Jeff Lynn on all things US.
So something is happening in the US, and we need to make sure that we take it into account in our investments. So there is a huge dialogue, discussion among all of our teams when it comes to understanding the US market. And that's also why we really pride ourselves on having very diverse teams.
American exceptionalism is absolutely real, and it's also incredibly powerful, and it's been incredibly powerful for investors.
I will say that the idea of US exceptionalism is justified by the performance across most asset classes, I would say, justified by the deeper liquidity that you get, which is very valuable in normal times.
The companies think big, entrepreneurs think big, and because there's been a precedent of so many companies, investors are willing to fund a next company.
The dirty little secret with valuation is it's not a great predictor of expected returns in the short to medium term. So if you were to plot valuations versus one-year returns, there's essentially no correlation.
So actually a relatively small difference in long-term growth rate has a tremendous impact to the current valuation. And that's actually very, very important when we look at companies. When you think about AI, it's an extension of the computing experience that we've had for really almost 50 years now. We're actually over 50 years now. And so the key thing to remember is that whenever computing power increases and the accessibility to that compute power increases, the addressable market for computing increases.
The equities market is so large and deep that that there's plenty of sectors, themes, like new developments that can still offer attractive returns.
As a CIO, it's something that I need to make sure my teams understand. They understand that they need to think differently, like having a local bias is not going to help us deliver investment returns for our clients. We need to think in a much more global way.
Coming up, fixed income, an asset class for all weathers. We introduce our new CIO, Andy Chorlton, who'll be hosting a panel discussion between Eva Sunwai, Richard Woolnough and James King, covering the full range of fixed income from rates, govies, credit and structured ABS. We ask, is credit just for summer?
And I think certainly the one thing that has changed for fixed income investors since the end of zero rates and QE is that fixed income actually provides income again. It's actually a component of return in clients' portfolios. It's not just there as a diversifier or perhaps for liquidity. Fixed income people tend to be glass half empty type people. So we're always looking at the downside. What happens if yields rise? That's always the question you get from clients, from colleagues, but what happens if yields rise? Structured credit is a very broad-ranging asset class. And as a result, if we talk about the opportunity set or the title of this presentation, fixed income for all weathers, I think structured credit is truly one of those asset classes that can do it because different things work in different environments.
Yeah, I think it's important to look at both investment grade and sort of non-investment grade opportunities. On the investment grade side, we still see a significant risk premium over more vanilla credit, and a lot of that is sort of due to I think the asset class still suffers from some misconceptions in Europe in terms of its robustness, but also no doubt there's a regulatory part of that picture as well that's keeping spreads high. So we think on the investment grade side, the premium across the board is pretty interesting. On the non-investment grade side, it's a bit more nuanced, and we're seeing a lot of the opportunity is actually coming from more private markets. 25 years ago or even 20 years ago, you would expect banks to fill that gap. If there's a new market that needs financing, you would expect banks to sort of rush in and fill that gap. increasingly, most banks aren't sort of set up to do that. So we're seeing this sort of rise of the non-bank lender sort of coming into a lot of these areas. And again, they need finance. They need secured finance. And so that's, for us, a very interesting area because some of these corporates have a limited credit track record. You wouldn't really want to lend to them on an unsecured basis, but they generate very interesting assets, and in an asset-backed format, you can actually get what we think is a very nice sort of risk-return dynamic.
The theme is all weather, but obviously different things work at different times, and so at times you want to take lots of credit risk, maybe on a hot day. Sometimes you want to take lots of duration, no credit risk on a cold day, but it doesn't work in all environments. But the beauty of our asset class is we can adapt to those environments. The equity world just goes cash or non-cash, low beta, high beta. You don't know what low beta or high beta is till after the event, quite often. So we have got that weather, we can move around in those particular things.
You are protected in bonds by the 0%, by the lower bound. And I think no one's tried yet to implement negative rates, but never say never. But so far we've never seen that. And so when you have government bond yields that are so low, and you have areas where you can naturally, by moving up the risk, by moving up the quality spectrum, just sit on higher yields, for us that seems like a really attractive place to be. And so Chinese government bonds, Japanese government bonds, for us are some of our biggest underweights, but there is an asymmetric return profile there. And so we think there's a lot of benefit of active management in sovereigns at the moment. I think we are looking fundamentally at a very different backdrop compared to 2022, right? We are looking at a different fiscal backdrop, a different growth backdrop, a very ultimately different drivers, but yields ultimately are not looking that different. So for us on a cross-market basis, we actually think gilts look like a reasonable place to take some duration risk because we do feel like, as you said earlier, a lot of the bad news is priced in. And we do think that the Bank of England will probably need to start acknowledging some of the weaker data a bit more and therefore price a bit more dovishness into policy rates. And so we like front-dated gilts as well as we like longer-dated. So cross-market, I actually think they look reasonably attractive.
And we're not perpetually long rates or perpetually long credit risk or perpetually long anything. You look at all the different strategies with the definition of an active manager taking value or taking positions where we feel there's value.
Whether you're an asset allocator or a fund selector that's building diversified portfolios, then this session is very much for you. Because being nimble in strategic asset allocation is the key to managing volatility, meeting diversification needs, and ultimately managing risk across investor portfolios. Stephen Andrew, Maria Maniki, and Tristan Hansen will discuss some of the ways in which they're managing their respective portfolios across income, climate-aware, and total return portfolios on behalf of their investors.
So our edge, really, is about being disciplined about this process. So this process starts by looking at, well, where are we today? We can't know where we're going tomorrow and what the risks are unless we see where we are today. So we're asset allocators and we're allocating assets across the piece in these areas, but with some very clear lines of distinction, because this tells us essentially the level of the market's confidence over or under relative to what those fundamentals are doing. And then we need to have a perspective on saying, well, is there a great deal of confidence in the price given what's happening with those fundamentals? Are they contradicting those fundamentals? And where do we have an argument with those fundamentals?
If you look at, for example, some of our balance funds, you will see that the average fixed income position is probably not far from the peers, but actually the characteristics within that fixed income exposure are very, very different. One key difference is the duration that Tristan alluded to, both from a strategic standpoint and more tactical on trades like the gilts of late, but also what else we own within fixed income. You will see that many peers in the space will tend to have a large exposure to credit still, while within this space we favor emerging market government bonds in local currency. And this has been and is today a very interesting trade, I believe, because if you look at the nominal yields as well as the real yields available in different areas within emerging market, you really are getting quite a substantial pickup from other asset classes. But there are some very interesting opportunities if we're able to scale this position accordingly within the portfolio. So obviously how much we own is very important from a risk-return perspective, but also on how do we build this exposure. And we really managed to build a well-diversified basket, taking into account the different characteristics of various emerging markets. For example, last year we've seen very differentiated behavior between South Africa and Latin American markets. And by being active within the basket that we have in the portfolios, we're able to capture these differentiated returns.
I think one never should be wedded to a kind of a forward-looking forecast or view. You can have scenarios that you think about or things that you think are perhaps more likely than others, but you have to be, going back to the title of the session, nimble, and you have to just realize that markets move for a whole host of reasons, and there are always going to be surprises. We're not looking to respond to every twist and turn in the market or responding to news in particular.
So an awful lot can happen in a shorter term basis, and to stop you from being pulled off your investment path, you absolutely need a North Star, something that keeps you coming in every day, something that keeps you motivated, and something that keeps you on the straight and narrow. Because I've seen too many good fund managers, very credible, passionate people who are very intelligent, who have just been completely knocked off course by the markets, and they never find a way back because their pathway isn't clear enough. You know, so when I'm talking about teams, think portfolios. When I'm talking about players, think stocks. It's exactly the same thing. Are you capable of regenerating the portfolio to then survive in a different investment regime and still deliver on your North Star? So, North Star, ability to evolve and adapt, and then lastly, bucket loads of emotional resilience. And I mean bucket loads of emotional resilience. Of course, clients should be able to ask the toughest questions whenever they want. The difficult part of this is having to have emboldened, impassioned defense to try and keep clients in the fund, not because of some commercial gain or trying to keep AUM high for profitability. It's because you actually care. You actually care that you don't want people to be buying up here and selling down here. And you know that if you don't bring lots of emotion to that defense and you don't bring real solid reasons why you passionately believe it's going to come back, then you're going to lose a lot of them.
Thanks very much for watching, and we look forward to seeing you next year.